Interactive Strength, TRNR, is currently pulling off a Fast and Furious style gamble, but without the Hollywood safety net. This isn't your typical Silicon Valley fake-it-till-you-make-it PowerPoint startup. It's a high-stakes M&A surgery being performed on a bleeding balance sheet. If you want to see how a company buys up world-class fitness assets while flirting with bankruptcy every Tuesday, welcome to our 2025 Deep Dive. Right now, TRNR is like a gentleman in a bespoke Armani suit who realized he doesn't have enough change for the bus ride home. A 114% revenue surge sounds like a dream, right? But in the capital markets, growth without profit is just a slow-motion suicide. In 2025, TRNR lived like an extreme athlete. That revenue spike was a massive adrenaline shot from the Wattbike acquisition. However, look at the debt wall, $14.8 million due in 12 months, against a non-restricted cash pile of just $510,000. That's like having to pay off a Lamborghini next month, while your wallet only holds a coupon for a Big Mac. Let's talk numbers. The net loss narrowed by 31%, but they're still sitting in a $24 million crater. The silent killer here is the operating cash flow, negative $10 million. Essentially, every breath TRNR takes requires an external oxygen tank. This improved bottom line isn't a recovery. It's just moving from the ICU to a regular ward, while the ventilator is still plugged in. TRNR's revenue is dangerously lopsided. Hardware is king, making up 90% of the pie. Meanwhile, the SaaS subscription business, the supposed golden ticket of tech, is sporting a minus 108% gross margin. This means every time they sell a digital class, they're basically paying the customer to show up. TRNR is currently a miner, selling world-class shovels, while the actual gold mine is still full of expensive dirt. Post-Wattbike, TRNR's heart has officially migrated from the US to Europe. The UK market alone now drives over half the revenue. This geographic pivot is effectively TRNR's safe haven. While the North American home fitness market is a bloodbath of price wars, the European professional and B2B elite sectors have become their final lifeline. TRNR's operational logic is brilliant but brittle, 100% outsourced to Tier 1 ODM partners in Taiwan. It's the ultimate asset-light play. No factories, no assembly lines. But it also means their jugular is held by the supply chain. In today's geopolitical climate, relying on a single geographic node is like dancing ballet on a razor blade, elegant to watch, but zero room for error. Look at this area chart. The free cash flow gap for 2025 hit a staggering $64 million. That's money vanishing at a speed that would give a hedge fund manager heart palpitations. While the Wattbike merger in Q3 provided a slight bump, the underlying burn remains aggressive. TRNR's cash flow curve is like a roller coaster in zero gravity. Every turn feels like it could go off the rails. The $14.8 million debt wall is looming. For a company spending millions a month with a cash reserve barely enough to buy a few luxury cars, this is the endgame. If they don't refinance or convert this debt into equity within 12 months, the wall wins. This isn't business management anymore. It's a high-stakes game of Temple Run. The cost of survival here is brutal. Interest rates between 12% and 15%. That's essentially pawnshop pricing for capital. To keep the lights on, they've leaned heavily on at-the-market equity issuances, diluting shareholders with every breath. And let's not forget the $27 million impairment on FET tokens, a painful reminder that when your main business is bleeding, gambling on crypto rarely provides the miracle you're looking for. Meet the three musketeers: Wattbike for professional prestige, CLMBR for B2B scaling, and the new Ergatta acquisition to rescue those tragic SaaS margins. TRNR's strategy is clear. If you can't build the best from scratch, buy the best. This brand matrix is their only moat. As long as Wattbike remains the gold standard for Olympic athletes, TRNR still has a seat at the table. TRNR is playing a smart game of dodgeball by avoiding Peloton's mass-market red ocean. They are targeting the 1% pro athletes and high-end B2B hotels. This keeps their average selling price high. However, the top of the pyramid is small. TRNR needs to prove they can scale from Premier League locker rooms to the broader wealthy and motivated demographic, or this remains a very expensive boutique party. Here is the landmine. The company admitted to material weaknesses in financial reporting. In plain English, they don't have enough specialized accountants, and their systems are outdated. In the eyes of an investor, this is like being told, the brakes on this car might be loose, but I'm still going to drive it down this steep hill. Trust is the hardest thing to rebuild once the numbers start to blur. 2026 is the year of redemption. Q1 focuses on a $6.4 million legal settlement. Q2 is about debt-to-equity conversion. Q3 relies on Ergatta to boost digital margins. If they land this triple axle, TRNR survives. If one link breaks, this isn't a roadmap. It's an obituary. The margin for error is non-existent. The final diagnosis: TRNR is running a growth-by-acquisition marathon while carrying a backpack full of debt. They are buying premium assets to mask a fragile core. If it works, they are the next fitness empire. If it fails, they are a textbook case of over-leveraged ambition. For investors, it's not about how much you like working out. It's about how much you trust the management's financial gymnastics. If you enjoyed this hardcore corporate autopsy, let us know in the comments. Do you think TRNR's M&A life support can hold through 2026? To get the full presentation and raw data, click the link in the description or email us at sales@hdinresearch.com. I'm the Chief Analyst at HDIN Research. Follow at HDIN 230, and we'll see you in the next deep dive.